Hello, this is Jordan. This video is being recorded on the evening of Thursday, October 27th, 2022. Thank you so much for joining me today. In this video, I am going to discuss and analyze where the stock market is right now with respect to history and that bear market template I like to use and what could be coming not only over the next couple months, but over the next 6 months or so. And in the title there, I put the word crash and tech stock and bear market, so this will get more views. So it's not entirely about the tech results, but that is important because the very poor earnings results that we're seeing from these very important tech companies, it's a signal that, recession is probably imminent. I'm not an economist, but that's just my take. And so the first thing, I got a lot of charts here. I'll try not to spend 10 minutes on each one so the video is not too long, but I discussed this, I believe, in a video I recorded yesterday. If not yesterday, it was the day before. And so this is from Barry Bannister at Stifel. I think it's a month or two old. And if you look at the two lines, that's the real, so inflation-adjusted decline in the stock market based on when the NBER declares that a recession has begun. So looking at that, we can see, if we're looking at the blue line, 1949 to 1980, the recessions then, the red line, 82 to 2020, and we can see, look at the red line, a month or so before the recession is declared, you have a pretty sharp decline for about 3 months. And if we're looking at the blue, based on all that data, you have a sharp decline for, not only 3.5 months, but also 6 months. And the sharp decline begins when they declare the recession. Now, it's important to point out, we don't know when they are going to declare the recession until after the fact. If the market starts falling apart, let's say it starts falling apart November, December, odds are they're probably going to say that the recession began in November, December. So this is only helpful looking back. But the point here is that, when we get this accelerated decline, which I'm going to show you, that is in line with basically a recession. So when these mega bear markets, when there's this steep decline in the second half and you're getting towards the end of the bear market, that is with the declaration of recession. Of course, the market has already sniffed it out, or even beforehand, the market has sniffed out the problems. But that's the point. This steep decline is when it's basically obvious to everyone we're in a recession. And, to be a contrarian, and this is accurate, when they declare a recession, it's a little bit after that a major bottom could be coming. So, I don't want to talk about that for the stock market yet because we're still probably a ways off, but this is important here. So I've talked about the 6 mega bear markets. You don't see the 1937 bear market here, and that's because that bear market, it fell apart after the first bear market rally. So I've talked about this template where you have a decline of about around 20%, and then you get a rally that goes to the 200-day moving average. Now, you've seen that these 6 mega bear markets, you've seen that in every one, and we saw that in the 7th, the one that's going on now. We talked about that in the summer. It rallied up to the 200-day. It touched it 7.5 months in, which was exactly the average time that all these bear markets did that. Now, the 1937 bear, after that point, it really fell apart. It fell apart, and there wasn't really any little rally in between. So that's different from the other 5 ones here, because these 5 ones, what happened is, of course, the market declined after it tested the 200-day. It declined, but it wasn't a straight line decline. It declined, and then when it got down around the first low, it made a new low. It maybe consolidated a bit. Maybe it rallied. In some of these cases, it rallied back to the 200-day. And so it was after that point where the market really fell apart. So where we are right now, the market, the S&P, it made a new low recently, but now it's rallying. So and we've seen this in other bear markets. I mean, it's still in a downtrend. It's an obvious bear market. But looking at the history here, I'm talking about when is the point when these 5 markets really fell apart? When was that accelerated decline? And so I'm showing you for each one the time, at that point, the percentage off the high that the market was. Now, right now, the market's 21% off its high, and we're only 10 months in. So the market has to rally some more, and it probably will. We're in a bear market rally. If it rallies up to the 200-day in the next month, I think it could be down minus 15% or so, maybe minus 14%. I mean, depending on the 200-day and how, it's going to come down some in the next month anyway. But that gives you a sense of how where we are now compares. And if you look at the other 5, one of them tested the 200-day moving average. Now, the other 4, they all rallied really close to the 200-day moving average, but they didn't quite touch it. Some came really, really close. Others came, maybe 2 or 3% within. But I wanted to note that there. But I think where we are now, it's possible it could test the 200-day in the next month or two if the rally continues. Now, if it doesn't test the 200-day, what you could see is it gets close to it, then you kind of you see a bearish consolidation for a little while, even after you've rallied in price. Remember, price and time is also a component. So if it's going to take a couple months here before the market, begins that accelerated decline, that doesn't, if it takes 3 months, that doesn't necessarily mean that's 3 months where it goes straight up. It could go straight up for 1.5 months, and the other 1.5, it could just kind of consolidate below the high. Now, look there what happened next. Obviously, Great Depression, big. That wasn't the end of it. Looking at the other 4, that was pretty close to the end of it in almost every case. What we're setting up for potentially, just look at those declines. 2008, 42% decline, 2.5 months. That was a real crash. The tech market, tech bust in the early 2000s, 28% in 4 months. Now, in the 70s, those 2 bear markets, it took a little bit more time, so maybe that happens. Maybe that happens in this case. But where we are currently, we're 10 months in. So, based on history here, this rally could have another month to go. Maybe it has 2 or 3 more months, like I said, and you bearish consolidate for most of that. But we get close to the 200-day, or we touch it. That's 14 or 50% off the high, and that's when the market really falls apart. And I don't mean to babble on, but here is a picture. Shout out to Yuri Matzo. You can see there on Twitter. I took this image off his Twitter, so thank you, Yuri. But these markets, these mega bear markets follow a similar pattern. And look, you can see this is not exactly the same, but what we're looking at here at this point, when markets really start to fall apart, it's basically a bearish consolidation. They're rebounding. It's a bear market rally. But if you're using a bird's eye view, it looks like a bearish consolidation. And you can see here in 2022, even if this doesn't necessarily have to copy 2008 exactly, I tend to think it could rally more. It could rally up to 4,000. But this is scary. Just think about the white line there. What happens when this market starts to decline again? You're going to see an accelerated decline. This is just a sketch of what I've been talking about and what could possibly play out. And so, over the next couple months, maybe this rallies up close to the 200-day, which is, I think, in a month or two is probably going to be around 4,000. So the S&P could rally a little bit more, but then it could really start to fall apart. If we look at, let's just say a 30% decline in 6 months. Let's take that, which is kind of the least. They're all horrible, but a 30% decline, if you rally up to 4,000, that's 2,800. A 30% decline is 2,800. 6 months would mean middle of the year. Now, a lot of people say you tend to get market lows in October or March. I mean, I don't know. Looking what's happening, I think the bear market low is probably, it could be October of next year, so it could be 12 months away. I don't think there's any way it's only going to be 6 months away. But I could be wrong about that. But anyway, I don't mean to babble on, but this is just a visual expression of looking at the history I've shared and how this could play out. The biggest takeaway is basically we're in a bear market rally right now, and if that rolls over and it really looks like we're going into a recession, or a recession has begun, look out, because the market then could have a really nasty 2023, especially in the first half. And if this plays out here, you see my sketch here. If this plays out and the market starts an accelerated decline or an acceleration to the downside, before winter is over, they're going to be cutting rates really soon. I mean, this pivot, that talk. I mean, it all seems ridiculous right now. Market's at 3,800. They're not going to pivot, blah, blah, blah. But guys, think about 3, 4, 5 months from now. You have the S&P breaking below 3,500. The economy's in a recession. They've already hiked rates significantly. They're going to cut rates. This is not rocket science. This is what always happens. And by the way, you're in a recession, the rate of inflation is going to come down. That's going to come down. Doesn't mean it's going to come down to 1 or 2%, but it's going to come down. And this is going to be really good for gold when inflation is still at 5, 4, maybe 3.5%, and they're cutting rates, back down to 2%. And then you're going to, when they have to cut rates, that's when you're going to see gold rally back and, maybe break out to a new all-time high next year. We'll see. Well, I'm getting ahead of myself. I'm talking too much, but these are just my thoughts here and now. Let me know what you think in the video. Follow all my work at TheDailyGold.com. Thanks so much, and talk to you guys in the next video.